Hi there, Lee Thurburn again. Welcome back. Good to see you. Thank you for joining Livestream Lee. And today we're going to talk. I'm going to click go live. Looks like I'm having issues with LinkedIn again. So I'm going to have to, I'm just going to click this a few times and see if it does in fact connect. It doesn't look like it's going to connect. So what I'm going to have to do is I'm going to have to record this, and then I'm going to have to edit it, and I'm going to have to put it on LinkedIn. So as you can tell by my visual on my sneeze, I am suffering from issues with allergies today, but I'm not going to let that stop me from proceeding. So we've been talking about cash flow, and I'm going to continue with that. But before I do, I have a couple of things to share. First of all, please be sure and go to livestreamlee.com, join the community. When you do, you're going to get an account on Apricot Rocket. This will actually give you access to the Livestream Lee community. When you create the account, which is free, on the right-hand side, as you log in and you get to your account, you're going to see a bunch of buttons, one of which is going to say, tell us about your services. We want you to provide us with a brief profile of your business, including the services that you offer, so that we can help make introductions to you of people that are looking for the services that you offer. So that's one of the benefits of joining the Livestream Lee community. Be right back. So I apologize. I'm going to have to dart out many times during this live stream because, again, my allergies are kicking in. But please go to the livestreamlee.com and join the community. Before I move on, I want to introduce a friend of mine, Carlos Cantu. One of the things I talk about a lot is the importance of surrounding yourself as an entrepreneur with people that you trust. Now, I'm not an insurance expert. I don't really know. I don't live in the world of risks, but Carlos does. And Carlos is extremely knowledgeable about risk, things like directors and officers risk, umbrella liability, electronic hacking type of risks, cybersecurity risks. Carlos has been around the insurance world, well, a long time. And he is a great guy to run ideas by and a great guy to have on your team because he'll help you understand the exposures that you have that an inexpensive policy can help you avoid liability. One of the biggest challenges entrepreneurs have is as you become more successful, people target you as an opportunity, and there's all kinds of ways that you can be exposed. And so protect your company, protect all the hard work that you've put into building your business. Have a risk management specialist like Carlos on your team. And if you don't already have one, go to livestreamlee.com, look on the right-hand side, find the Carlos Cantu button, and go check out Carlos, give him a call. He's a great guy to have on your side. All right. Let's go ahead and jump in now and continue our conversation about cash flow projection spreadsheets. And so I'm going to go ahead and just fill the screen with the spreadsheet. And I'm going to pop over here so I can actually see the spreadsheet as I work on it. Now, before we dig deeper, I want to go back to something that we covered on Thursday of last week in our prior episode. And I showed you how to calculate a few things related to payroll. I'm actually back on the payroll tab in the spreadsheet. And we're doing a sample business plan for a restaurant here. So I say store manager, we have a payroll person for store manager. That's, the restaurant's the store, restaurant manager. We have a payroll line item for the chef. We have some payroll line items for kitchen help. And we just simply have dollar amounts in here. Now, I've put in plenty of money to be able to run a decent little restaurant. Obviously, if you're running a much bigger affair, you're going to have totally different numbers. I've also done something that is really not good form, but for the purpose of showing you how the spreadsheet is built, I have done this just for simplicity's perspective. And what I did is I just copied the $5,000 across, and then I changed it at the 6 months. So in other words, I just took this cell and I just dragged it over. And then at the 6 month point, starting in month number 7, I added $500 a month to the cost. Now, the reality is you're going to have a much more complicated thought process regarding how you pay people. And so you're not just going to put in a value and drag it across. But for the purposes of illustrating how the spreadsheet works, that's what I've done. Now, the total payroll, this field right here, is a sum of all of these fields above it. And after you figure in your total payroll, you may very well have benefits. Now, your benefits might be something like health insurance or something else. So your benefits are going to, if you offer them, are going to be typically paid on your gross payroll. So the idea here is you take a benefit line and you factor in a benefit. Now, if your benefit is simply easily calculated as a percentage of your payroll, you can put the percentage in this first field, and let's say it's 5%. So I'll put in a 0.05. Now I'm going to make that show the 2 decimals. And now what I'm going to do is I'm going to multiply 0.05 times the payroll, the total payroll, and you'll see we get $1,000. Well, I've already set my taxable payroll as the total payroll plus the benefit. The taxable payroll is the amount that you'll pay taxes on. So now that I've got this field in here, what I'm going to do is I'm going to set, basically I'm going to lock the calculation in on column B by putting a dollar sign in front of the column B character. Now I can simply drag this across, and as the payroll, taxable payroll changes, the amount of the benefit will change. Now that we have a taxable payroll amount, you can calculate your federal unemployment tax, Medicare, Social Security, and state taxes. Your federal unemployment tax is 6% of the first $7,000. Now, the reality is you're going to have a mix of people, some of which are going to make more than 7,000, some are going to make less than 7,000. You'll probably have quite a few that don't make much more than 7,000. If you're in a restaurant business, you'll have some part-time employees and so on. So for the purpose of calculating, rather than getting much more complicated and trying to calculate what your total payroll has and how much, I'd like to just take a percentage that's less than 6% and apply it to the total payroll. And then I can just take these and I can drag them across because I've done the same thing. Notice in this field how I have put a string B. I call that a string. That's a dollar sign, string B. So I'm just going to copy these all the way across. Excuse me just a second. I really apologize. I had to, again, deal with my allergies. Okay, so I just copied these across. And again, as your total payroll changes, it'll automatically calculate down. And then your total payroll cost goes up. Now, gets applied to get this total payroll gets rolled up to your expense line. So 22,803.50, 22,803.50. If I go to expenses, you can see here's the 22,803.50. It just rounds to 22,804. Now, I previously inserted some dollar amounts for things like interest expense and workers' comp. And these are easy numbers because they pretty much stay the same across. Bank service charges, you may not have any. Most likely you won't have any charitable donations. You might have some contract labor. If you do, you put in your contract labor amounts, whatever they are. If you're going to have any, I'm going to come on down to, if you're going to borrow any money, you're going to have interest expenses, which are going to show up. You may have some postage and delivery, some printing and reproduction. You may have some professional fees for things like accounting, websites, legal fees. Rent, you're definitely going to have rent. And you're going to have some supplies, maybe for marketing, maybe for the office. You'll definitely have some telephone expense. So let's just go ahead and plug a telephone expense, $350 in. And let's just say that that's a pretty steady amount month over month. Well, you may or may not have travel and entertainment and meals, that kind of thing. Excuse me again, just a second. Okay, I'm back. I apologize again for my allergies. But you see, you just go through each individual line item and you put in your amounts for these individual line items. And what will end up happening is the total expense will now flow all the way up to your summary page. And here is your total expense flowing all the way up to your summary page. So we've talked about revenues, and we've talked about cost of sales, and we've talked about total expenses. And here you have your net income line. Now, your net income line has built into it expenses. One of them is your other expense projection, which is your total expenses. So if I come down to the expense projection total expenses line here, and I look back up, there's something that we haven't talked about. And that is, where is it? Here it is. Amortization and depreciation. Amortization and depreciation are expenses that you recognize when you notice or as a result of the decline in value of an asset. So everybody knows a car becomes worth less over time. Same thing is true with every single asset with the possible exception of real estate. Now, real estate, even though it may not become worth less over time, the tax regulations allow you to write it off. So what you're going to show here is the declining value expense that you take for an asset that you've purchased. If you're doing a restaurant, you're going to have things like refrigerators and freezers and steam tables and ovens and stoves and tables and all kinds of stuff. You're just going to have a ton of different things. Now, each asset is a different class and has a different depreciation rate, but you're going to have a depreciation number that's going to show up based upon whatever the total amount of money that you spend is for those assets. And so what I'm going to do is I'm just going to put an amortization number in here for the depreciation. It doesn't really matter what that number calculates out or how you calculate it. The important thing right now is to recognize that when you do have depreciation, you're recording an expense that you don't actually cut a check for. Okay, that's not a cash expense. So even though you're showing it as an expense, you didn't spend any actual cash for this. The reason I'm pointing this out is as we come down, you'll see that the total amount has gone up from $25,804 to $26,804. So now this is the total expense. So now we come back over and you'll see your total expense line has gone up, which means your net income line is affected. And in this case, your loss has gone up, your loss has gone down, your profit has gone down. Okay, so how do we account for that? Well, here is your amortization and depreciation line item. And so what we're going to do is we're going to go to your expense line item. We're going to go up and find your amortization and depreciation. And I'm just going to do 12 months. I'm going to copy the 12-month number over. And I'm going to, basically, I'm just going to hit copy. Okay, so now we're going to come to your total summary. And here I'm going to do a, let's see here, paste options, paste special. And I'm going to paste a link, and boom, you'll see that amortization and depreciation got copied in. Okay, so again, excuse me for just a second. Again, I apologize. I don't know how to how to prevent my allergies from kicking in, other than to remove myself momentarily. Okay, so amortization has been shown and is included in this $7,700, $7,729 loss. But the reality is, I didn't spend $1,000 for depreciation and amortization. So I need to remove the $1,000 from this loss, which means my actual cash flow is only $67.29 out the door instead of $77.29. So your amortization and depreciation gets added back as a reduction in profit, as a reduction in cash loss, or as an increase in profit. It's not actually an increase in profit, but you have to adjust your net income, which is your profit line, upward by that amount. So what we see here is that our cash flow actually was out negative $67.29 for the first month. Now the second month, it was out $21.24. You have to take the $31.24 and adjust it for the $1,000. So you take the adjusted cash flow the first month of $67.29 plus the negative cash flow of $21.24 for the second month. You add them together and you have a negative cash flow of $88.52. And remember, there's some rounding in there that you're not seeing because I'm really only looking at the whole dollars. So by going through this exercise month after month after month, you get a chance to see what your actual cash flow burn is going to be. So your cash flow is minus 67, minus 21, then plus 39. So your total cash that you're going to need to get to month number 2 is $8,800. Now, the reality is most businesses are going to have anywhere between 6 and 24 months of negative cash flow. So the answer to the question of how much cash are you going to need to get this business off the ground cannot be answered until you can look at a cash flow projection spreadsheet like this and see what your maximum negative number is on your net cash available. So once you've come up with your maximum negative number on your net cash available, now you know how much cash you're going to need to get the business to the point that it starts generating positive cash flow. Now, I'm going to tell you right now, these numbers are unrealistic for a business to be able to, for a restaurant to be able to generate these kinds of positive cash flows the first half year, the first few months. And the reason that they're not realistic is because of this right here, the revenue line. The revenue line is probably not realistic. So how do we know how to predict revenue? I'm going to tell you that's the single biggest challenge that entrepreneurs have, is figuring out what their revenues are going to be, predicting their revenues realistically. Okay, so how are we going to do that? Well, I've got a simple example. Hopefully this is simple. We're going to talk about one type of marketing, and that is direct mail marketing. Now, there's a lot of different marketing that your business could do. You could rent a sign that blinks and put it out by the highway. You could rent pay somebody to wear a gorilla outfit and spin a sign. You could put a big floppy man, the kind that blow up with a balloon and flop in the wind. You could do direct mail. You could do radio advertising. You could put advertisements on doors. You could buy an advertisement in a local newspaper. I mean, there's just a tremendous number of things that you could spend your money on advertising. Every one of these things you need to think about exactly like I'm going to present here. So I'm going to give you a thought process to go through that works for direct mail, and it's a good illustration of how you would think about this for any and every social media, any and every marketing that you're going to do. You want to think the same way. So for direct mail, first of all, let's presume that we mail 1,000 messages, 1,000 letters to your local community. Remember, you're putting an advertisement in somewhere, could be North Dallas, South Arlington, West Fort Worth. I don't care where you're putting it, but you're putting a restaurant into a community. So you want to market. So let's say you send out 1,000 direct mail pieces. So let's put the number 1,000 here in the row for direct mail pieces. Now, we know that a stamp costs, I think it's, I say we know, I'm not sure, I haven't bought a stamp on. I think it's 57 cents. So we're going to put 57 here, and we're going to multiply plus 57 times 1,000, and we have $570. So our postage cost for this mailing is $570. Now we're going to have a cost for the insert that we put into the envelope. Okay, so we're going to have a cost there, and let's just include the cost of the envelope in this because envelopes are pretty inexpensive. So we'll just consider our printing and our paper cost all together. So let's say that we print a really nice flyer inside, something nice that goes inside the envelope. Let's say we spend 50 cents per unit on that. Well, the cost of our printing and paper is going to be plus 50 cents times 1,000, the number of pieces that we send out. Now, you're going to have to assemble the envelopes. You're going to have somebody put the content inside the envelope and seal the envelope and put a stamp on it and all that kind of stuff. So let's just say that that's 20 cents per envelope. So we'll go over here at 0.20. And like the same as before, we'll multiply the 20 cents times the 1,000 envelopes. And now we come up with $1.27 total cost. And for 1,000 envelopes, it's $1,270. So now we know how much money we're going to spend. So the next question becomes, how many people are going to open the envelope? Well, you have a lot of control over that. The easiest way to answer this is, probably 2% will open it. Well, that's true if you don't give them a reason to open it. So to give them a reason to open it, it's important because you're not going to be able to get somebody into your restaurant a second time until you get them in a first time. They're not going to be able to refer your restaurant until they've been to your restaurant themselves. So you've got to prime the pump and get the ball rolling. So how do you do that? Well, you've got to get the envelope opened. And so I recommend that you do something like use lumpy mail. Now, lumpy mail means that when somebody gets the envelope in the mail, then when they hold the envelope, they can tell there's something valuable or at least interesting inside. That's lumpy. You've received most likely pins in the mail before from promotional companies that want you to buy their promotional items. Please excuse me, I have to pause again. Okay, I'm back. So to increase the open rate, let's presume the following. Let's say that you're opening a pizza parlor, and so you send out an envelope, and inside the envelope is a piece of nice hard cardboard with a glossy image on the front that looks like a piece of pizza. And when somebody holds the envelope, they can tell that there's something interesting shape, like a pizza shape, a triangle shape, and that it's lumpy. This is lumpy mail. So that's going to dramatically increase the open rate. So you're probably going to get an open rate in the realm of, say, 70%, 60%. So I'm going to put 0.6. Well, if we have 0.6 times 1,000, that's 600 envelopes that are going to be opened. Now, what kind of response are we going to get? How many people are actually going to do something with that? Well, if to use the same thought process, let's say that you want people to come in and get a free 8-inch pizza. Well, if you send me a pizza slice in the mail and it tells me that I can bring that slice in and exchange it for an 8-inch pizza, I'm pretty likely to take you up on that because I love free food, and I think most people do. So you're probably going to have something in the neighborhood of a 75% open rate. So let's say 0.75 times 600. So now we've multiplied the 600 opens by a 75% response rate, and we have 450 people that are going to redeem this offer to get a free 8-inch pizza. Okay, now let's think about what that means. Okay, so we're going to get 450 people to get a free pizza. We haven't made any money. But the next thing is what is our upgrade rate? So how many people are going to come in and get a free 8-inch pizza and not buy anything else? I mean, there's going to be sodas. There's going to be additional pizza. An 8-inch pizza is good for maybe 1, maybe 2 people. Excuse me again, please. So an 8-inch pizza is good for maybe 1 person. Well, most of the time, somebody's going to get a pizza. They're going to want to feed a couple of people, maybe 3 or 4. So chances are pretty good you're going to sell an additional pizza. Okay, so now let's make the presumption that an 8-inch pizza sells for $8. I don't know, you can put whatever number you want in, but let's say it sells for $8. So what I'm going to do is I'm going to say the upgrade redemption dollar is 8. Okay, so we're going to have $8 for a redemption. And let's say that 50% of the people are going to upgrade. So I'm going to put a 0.5. And what that's going to mean is 0.5 times 450. We're going to have 225 people that are going to upgrade. So what we're going to do is we're going to have a total upgrade revenue of $1,800. Okay, so now for our free promotion with lumpy mail, we're going to make $1,800. Well, let's think about, just because we want to know, what's going to be our cost related to that. So let's say the cost per redemption, typically about 25 cents on the dollar is your food cost. And pizza is probably a little lower, but let's say 25 cents on the dollar. So the pizza is an $8 pizza. So 25% of that is probably $2. Well, let's make it $2.50. And so our product cost per redemption is $2.50. 450 times 250 means we're going to have $1,125 of pizza costs for our free pizzas. Okay, so we're also going to have 225 purchased pizzas. So our production cost for purchased pizzas will be the same. So plus 250 times 225. So let's do the math now. Let's calculate how this promotion works out. We have a direct mail cost of $1,250. So we've spent $1,250. I'm going to move that over into this column. Okay, $1,270. We have a production cost of $125. And then we have the cost, that's for the free pizzas we gave away. And then we have purchase pizza cost of this. So the total cost that we have for this promotion, I'm going to just do a sum, and I'm going to come all the way up here. The total costs for this promotion are $2,957. Our revenue is $1,800. Okay, so if we do what our net is, it's going to be plus 1,800 minus 2,900. So we've had a total expenditure of $1,157. We've had an expenditure of $1,157, but we've gained 450 customers. So I divide that 1,150 by 450 by the 450 customers, and I've spent $2.57 to get a customer. That customer can come back time after time after time over the next 5 or 10 years. And if they like our pizza, they're going to come back and they're going to spend money, and we're going to make money. So now the question becomes, how much do I want to spend to grow my business? So for me to get $1,800 in revenues with a net cost of $1,157 for every 1,000 direct mail pieces I send out, what happens if I send out 2,000 direct mail pieces? So I just change this number to 2,000, and I come down here, and my cost per unit is still $25.57, but now I'm making $3,600, and I'm spending $2,300 to make $3,600. Spending $2,300 in marketing for $3,600 in revenue. That's quite, I made a mistake here. So I'm spend loss. I'm spending $5,900 and I'm making $3,600. So I have a net cash out of $2,315. So here's, and I know I'm going over, but here's what I want to do. Now I know how much revenue I can expect for an expenditure. So now all I have to do is decide how much I'm willing to spend, and I can now come in and I can change this. So let's say that I have the ability to spend $12,000, let's say that I have the ability to spend $5,000 negative cash flow for marketing. So here's $2,300. I can come up here, I can send out 4,000 direct mail pieces. And by sending out 4,000 direct mail pieces using this thought process, I'm going to generate $7,200 in revenue, but my net cash flow is going to be a negative $46.30. Well, now I can come in and I can say for month number 1, I'm willing to do that. So I can come back over here to my DFW revenue projections. Remember I said I'm going to have $7,200 in revenue. So I can come back over to my revenue projections and I can say for my food sales, I'm going to have $7,200. Okay. Now I don't just increase necessarily by this. I can now factor in what my food costs, how much I'm willing to spend in the way of direct marketing, to do direct marketing. So this revenue is built solely on the concept of direct mail marketing to drive people. So if I want this number to grow next month to a bigger number, I just come down here and I say, how much am I willing to spend the next month? Now, here's where it gets kind of cool. Some of the people, the total 1,800 people that redeemed, and these are the total number of customers based upon sending out 4,000 direct mail pieces. Some of these 1,800 people are going to come back next month, but they're not going to have a coupon. So they're going to generate much more positive cash flow. So in tomorrow's cash flow, conversation, what we're going to do is we're going to go in and we're going to break out your revenue by a couple of different revenue types. And we're going to show how you start predicting based upon a marketing budget and a projected return of previous customers. You remember, you're building a customer base and you're getting those customers to come back. So your marketing conversation starts to get progressively a little bit more complicated. But this thought process allows you to get very granular about what kind of realistic expectations you can put on your marketing and what kind of budget do you have to work with. All right, so I'm going to come back over and come in, and I'm going to pause for just a second. And again, I'm going to apologize to you for the interruptions. The allergy is, we all get them. So what I've done is I've talked to you about how the cash flow projections are tied to your marketing, how your revenue projections are tied to your marketing. Tomorrow, I'm going to take that to the next level of iteration and talk to you about how you can factor in both new marketing to get first-time visitors in and repeat marketing to get second-time visitors in, and how you can layer that in to get a more accurate, more sophisticated perspective of what your revenues and your cash flows and your profits will look like as you grow this business on out. All right. Before I end, I have somebody I want to tell you about. I'm a big fan of history. I don't know about you. I love Winston Churchill and World War II and all this kind of stuff. To me, history is one of these fascinating things. There's always interesting characters. Dan Nelson is a genealogist. Now, Dan sends out a newsletter that I get. He sends it out every couple of weeks. It is without a doubt, it comes out on Saturday. It's without a doubt one of the most interesting reads I get. And he always has interesting characters, interesting historical snippets. During the election season, he had a lot of comparisons with previous elections in our history. A couple of weeks ago, he sent out a link to a website where you could see pictures of former presidents like George Washington or Abraham Lincoln, what they would look like if they were modern presidents based upon hairstyles and facial, hair and all that kind of stuff. What would these people have looked like? It's really interesting stuff. If you like that kind of stuff, go to livestreamlee.com and click on the Dan Nelson link and sign up for Dan's newsletter. You are going to love getting this thing. Now, of course, if you want to, you can unsubscribe if you don't like it. But Dan really has one of the most interesting newsletters you're going to get. So do yourself a favor. If you're a history buff, go check out Dan's newsletter. You're going to be glad you did. Also, be sure and go to Livestream Lee. As I told you about earlier, do that. Get signed up. Get on the program. And in the meantime, thank you for your time today. I've gone way over, but I wanted to make sure that I got everything in. Sorry for the LinkedIn streaming problem, but I will have that fixed when I edit. And you know what I'm going to do? I'm going to edit out all of my sneeze breaks. So it'll probably be a lot more concise. Thank you for tuning in. See you tomorrow at 3 o'clock. Bye.